Hello, this is Steve Malone with CompositeFX. Hope you're doing well today and you're getting some good trades. I've been asked by some traders if I had to answer some questions related to the average price bars. The average price bars is part of the synergy trading method that I've been trading since 2005. So today I want to answer a couple of specific questions related to average price bars. What are they, and why do you use them instead of normal Japanese candlesticks? Average price bars are a modification of the Heikin Ashi candlestick method. Heikin means average, Ashi means bar or standard. So we're looking for the average price in the Heikin Ashi method. However, what I found in the Heikin Ashi method, as I explored the averaging formula, I found at times that the Heikin Ashi method did not stay in check with the active price in the Forex. The Heikin Ashi method was developed by a trader by the name of Dan Valcoux, and Dan used this technique when trading stocks and commodities. What I find with the normal Heikin Ashi method, which is taking the average here of the open, high, low, and close, and then putting it into a particular formula where you're looking for the maximum high over a period of time compared to the maximum low over a period of time, and you're averaging the price, I found that oftentimes in the Forex market that it has a tendency to lag a little bit too much with the active movement that we see in the close price in the Forex. Therefore, I've modified the formula a bit, and what I have now is the average price bars. So the average price bars are a modified Heikin Ashi candlestick. They're designed to follow the close price better than normal Heikin Ashi candlesticks. They reduce the extreme high and low wicks found in Heikin Ashi candlesticks. So make note, they're not your normal Heikin Ashi candlesticks. They give a better depiction of current market price by reducing choppiness found in nominal price action. What I mean by that is if you're constantly looking at the close price of a Japanese candlestick or a regular bar chart, the close price is up and down, almost like a fish out of water, flopping about. It's very difficult to oftentimes depict what the market's going to do based on what the market's been doing with the close price moving up and down rapidly, especially in a high volatile situation. So you can smooth out what you're looking at by using an averaging technique. The average price bars found in the synergy trading method allow traders to see what's going on in price action better than the choppiness found in normal close price activity. And the average price bars reveal market strength and consolidation. Now there are three variations of the average price bars. First off is the long average price bar. This is a buy candle, and if you notice that it has a body that's blue and wicks that are also blue, and it indicates an uptrend. Now make note, when there's an average price bar with no lower wick, this is a strong uptrend indication. Therefore, you're able to stay into the long trend or the uptrend in the market. The second variation of the average price bar is a red sell short average price bar. The body and the wicks are red, and with no upper wick, this is a great indication for you as a trader just by price activity alone that you could stay in the trade as it continues to push down. The third variation is the small body average price bars. This is where the body of the average price bars, whether blue or red, is much smaller. Oftentimes the wicks are about the same size. Sometimes the wicks can even be larger, almost synonymous with a doji-like candle in the normal Japanese candlesticks. This indicates a potential trend change. So if you're in a position, you want to consider exiting. And if you're waiting to enter into a trade, you may want to consider waiting a bit longer until we have either a normal blue candle with an uptrend situation or a normal red candle in a downtrend situation. Now in the near future we're going to be releasing Synergy Pro, and Synergy Pro has two additional variations of the average price bars. One of the variations is what's going to be known as the reversal average price bar. This is an indication that the market is reversing. So suppose for the moment we're in a downtrend situation, what we'll have is red wicks But yet when we reach the bottom of the downtrend, we'll turn into a blue body, indicating that the trend is starting to change long. Whereas if we're in a long uptrend and we have blue wicks and then we get a red body, this is an indication that the market is reversing short. So this is a potential trend reversal indication. Another new variation of the average price bar is going to be the consolidating average price bars. This is letting us know by gray wicks, either with a blue or red body, the gray wicks indicate that the market is sideways, range bound, is consolidating. There's no clear direction here, so you might want to just simply let go of the mouse, step away from the keyboard, and let the market set itself up long or short, and look for the normal blue average price bars or the normal red average price bars before stepping into the marketplace. Now, why do I trade with the average price bars? There's two primary reasons. First, to help avoid false exit signals that we often get in Japanese candlesticks. If you notice here that we're in this downtrend, and obviously it's easier to see it after the fact, but in a downtrend situation, here was a potential long candle, and again another potential long situation, especially when you get a doji. Oftentimes a doji type candle is an instance for potential reversal. Well, that doesn't happen. As a matter of fact, the market got stronger after this doji-like candle and pushed further down. And again, here we're in a long trend situation, and then this double top situation here, both of them pin high about the same level, and this looks like a reversal. However, the market continues to make a push higher. So what I like to do is I like to focus, instead of on the Japanese candlesticks that could have potential false exits, to take a look at what it appears in the average price bars. You can see in this snapshot that the average price bars remain red to allow you to maintain that trend. And again, as the market's pushing up, even though the market pulls back here, the body of the candle remains blue and the wick remains blue, allowing us to focus on the trend. And that really is the second primary reason that I trade with the average price bars, is that I can focus on the trend. A lot of the up and down that's synonymous with the normal close price in the marketplace can get you jostled about a bit. But when I have no upper wicks, that's an indication that the market continues to push down. If I get an upper wick and a lower wick, this could mean that there's a possibility of a trend change and a potential move back to the upside. Well, finally I get that with a reversal candle. Here I have a blue body with red wicks. The market turns. I got a consolidation candle now as the market's trying to set up for this actual turn to the upside. But notice here, this was actually a reversal candle in the Japanese candlesticks, but here it just paints a lower high, but yet we continue with the upward trend. So hopefully this explanation of the average price bars and why I use the average price bars over the normal Japanese candlesticks will help you in your trading. This is D Malone with Compass FX. Y'all have a great day and get some good trades. We'll talk to you next time. Bye-bye.